everyone. I'm Radhika Merwin, and this is the big picture on monetary policy. In today's session, we will look at the issue of transmission. We have already seen the various monetary policy tools that the RBI uses to control interest rates and the supply of money. We have also seen what the RBI seeks to achieve by tweaking the rates and the money supply. To recap quickly, the RBI's monetary policy controls inflation, promotes growth, and maintains a stable exchange rate. Of these objectives, promoting growth is a critical one. The RBI does this by lowering interest rates to stimulate borrowings and hence investments. But while the RBI does set the direction for lower interest rates, in truth, most of the times it hasn't mattered much to borrowers. This is because banks are reluctant to pass on the rate cuts to borrowers. The full transmission of any rate cut happens only with a lag and in pockets. This brings us to the issue of transmission. Through most of last year, banks and India Inc. have been clamoring for rate cuts because they believe this is the only way to revive the economic growth. When RBI finally yielded and started to cut rates from January this year, banks that were demanding for rate cuts became tight-lipped. It took 2 rate cuts since January and a rap on the knuckles by the RBI governor for banks to finally start cutting their lending rates. Many banks have lowered their lending rates since the April policy. But aside from the lag with which the lending rates have moved lower, they have also not happened to the extent that the RBI has cut its own repo rate. So why have banks been reluctant to pass on the benefits to borrowers? And why have rate actions varied across banks? There are 3 main reasons for this. Hence, a widespread cut in lending rates is unlikely. Here too, different banks react differently. This is because each bank decides their lending rates based on base rates. A bank is free to decide their own base rate depending on their cost of funds, administrative costs, and profitability. Repo rate changes also impacts the cost of short-term borrowings. Hence, banks that rely heavily on short-term borrowings will benefit more when rates fall. These banks are likely to lower their lending rates faster than the others. 2. Rate actions also depend on the liquidity situation of individual banks. If a bank is facing a severe liquidity crunch, it will be reluctant to cut its deposit rates in a hurry. These banks will be forced to keep their deposit rates high even if the RBI lowers the repo rate. Hence, these banks are unlikely to cut their lending rates to keep their margins intact. The third reason why banks are reluctant to lower lending rates is also because of the high risk in the system. In times of slowdown, such as the one we are seeing now, banks are reluctant to lower lending rates because they want to earn a higher return on their loans to compensate for the risk. Across the board cut in lending rates is also unlikely because public sector banks that contribute a chunk of the lending are likely to take some more time to lower lending rates. Given their poor performance, they want to maintain their margins before cutting the lending rates. With high amount of bad loans, these banks are already earning lesser income on their assets. To address some of these issues, the RBI sought to streamline the computation of cost of funds for banks. Banks are currently now free to choose their own method. Most banks have adopted the average cost of funds method, and hence any increase or decrease in deposit rates does not impact the bulk of their deposits. The RBI has now nudged banks to follow the marginal cost of funds, and hence any increase or decrease on deposit rates will immediately impact their cost of funds and hence lending rates. While these measures are steps in the right direction, they will certainly take a longer period of time to yield results. Until such time, borrowers will have to live with slow transmission, which will happen in fits and starts.